Arguably within the past 5 years, maybe 6, 7 years, you've seen LNG become more to the forefront from as these long-term contracts have come to expiration. Pricing has changed in the marketplace. You've had a change in the participants in the marketplace. LNG becomes more of a known entity, and certainly, one can argue that the development and the advancement of fracking in the U.S. has brought LNG and just gas and natural gas in general to the forefront of being the reserve molecule in the marketplace. And there's no doubt that LNG is going to be as big as Brent crude oil, if not bigger than WTI, if not bigger. It is an incredibly important part of the energy transition. And the interesting thing and what brought us as an exchange, a futures exchange, a regulated futures exchange, to become involved in this market where nobody else has done it, is that we saw that there was no way for the marketplace to hedge and manage their risk of those extra molecules on the water.
Hello and welcome to this episode of the Energy Connects podcast with me, Chiranjib Sengupta, where we discuss the role of LNG as a fuel for change, from Asia to Alaska and beyond, and how that's impacting global trading markets. And you just got a sneak peek of my conversation with our guest today, Joe Raia, Chief Commercial Officer at Abaxx Exchange, a Singapore-based regulated commodity futures exchange. With more than 25 years of impressive experience in physical and financial commodity markets, Joe is a well-recognized figure in the industry. He is a former managing director and head of global commodity futures at Goldman Sachs, and former global head of energy and metals futures and options at CME NYMEX. Joe joins us today from the East Coast of the United States, where the discussion of late has focused increasingly on the energy industry. Joe, thanks very much for joining us on the Energy Connects podcast.
Thanks for having us.
To start off, a prominent theme in the industry is the emergence of LNG as an energy-based load. So what's been the trade impact of that?
It's an interesting question. We see and have seen for years, going back 20, 25 years, LNG as an important feedstock for the power generation market, particularly in Asia. But I would say, arguably within the past 5 years, maybe 6, 7 years, you've seen LNG become more to the forefront from as these long-term contracts have come to expiration. Pricing has changed in the marketplace. You've had a change in the participants in the marketplace. LNG becomes more of a known entity, not only for Asia feedstock, but also globally for feedstock. And certainly, one can argue that the development and the advancement of fracking in the U.S. has brought LNG and just gas and natural gas in general to the forefront of being the reserve molecule in the marketplace. So that's important. That's an important change. And that's also changed the dynamics of where does that LNG go.
And then obviously that has also impacted the trading mechanisms for the global energy market, and they have evolved. So how have trading mechanisms for the global LNG market evolved? And how is Abaxx Exchange helping its clients navigate this evolution?
To the first part of your question, that's the important part. So as these term contracts have all come to expiration, these were mostly 20 plus year term contracts. They would find a gas field in Indonesia. They would contract with a Japanese power company or trading company, build ships around it basically, and almost have a pipeline on the water from Indonesia or from the Middle East to Asia, China, Japan, South Korea, for the supply of that gas. And that's 20 plus years ago. And as those term contracts, as I mentioned, have come to expiration, the marketplace has said, well, there's more participants to play in the marketplace. There's different demand quotients in the marketplace. So how should we look at these term contracts? Should we extend them? Should we continue to go basis a long-term contract? And the marketplace has said generally, no, well, let's look at a mix. And so what you've seen is a change in the dynamics of term contracts, which was almost 100%, again, going back 10 years ago, to now probably in the past 5 years, 3 years, Now one can argue, and you look at the facts, you look at the numbers of at least 50% now spot market or non-long-term contracts. So that means what, 1 year, 5 years, 3 years. And with that, they've changed the clause in most of these contracts. So the long-term contracts had destination clauses where, again, it had to go from point A to point B, and there was no deviation or reselling of that LNG cargo. Now, most, if not all, new contracts are either, as I said, spot, or they move to a destination clause rider where they can basically take that cargo anywhere where the economics make sense to the buying entity. So you now see optimization of portfolios. You see spot cargoes mostly, brought from, as I mentioned, the reserve molecule of the U.S. Gulf up to Europe or even to Asia, and that's now being traded and optimized by the firms that are not only buying the cargoes of LNG but also selling the cargoes of LNG.
That's an excellent point, Joe. And taking a longer term view, what are your thoughts on the role of LNG as an essential enabler of the LNG transition?
There's no doubt. That's a great question. There's no doubt that LNG is going to be as big as Brent crude oil, if not bigger, bigger than WTI, if not bigger. It is an incredibly important part of the energy transition. And the interesting thing and what brought us as an exchange, a futures exchange, a regulated futures exchange, to become involved in this market where nobody else has done it, is that we saw that there was no way for the marketplace to hedge and manage their risk of those extra molecules on the water. Even the cargoes that are being resold, there is no way for that cargo to be hedged directly, and that has correlation directly to that waterborne LNG. And prior to our going live last June, the only entities that were or market related pricing instruments that were available were non-correlated crude contracts. So think about it. And we're talking about Japan here. You look at Japan taking a cargo of LNG from the U.S. Gulf, being delivered into Tokyo currently, or maybe over the past 5 years, so was priced to Brent crude oil a half a world away that had zero correlation. I would argue to see anybody that says that has any correlation, has zero correlation to that cargo of LNG being delivered into Japan. It's from a risk management perspective, it makes zero sense, and from a markets perspective, it makes even less than zero sense. So what we brought to the marketplace is a correlated LNG futures market for Asia, for Northwest Europe, and for the US that now has directly correlated pricing to those molecules of LNG that are on the water where it didn't exist before.
That's an excellent point. And you spoke about the market in Japan, which we'll speak about in a bit. But before that, I wanted to ask you, and you said you went live last June. How's been the experience so far, and what are your sort of key learnings from the last 8 months?
And there's two parts of that. There's the exchange part of it and the onboarding part of both trading firms, brokers, clearing firms on a new exchange. Abaxx is the first new clearinghouse, futures clearinghouse dedicated to commodities, and particular physical commodities, which makes that quotient even harder. That have been built from the ground up and launched in over 20 years, if not longer. And so we've taken the products that the marketplace was telling us they wanted and brought them and developed standardized futures contracts that are based on the OTC contracts that they're trading now in the marketplace, and brought them to the exchange where they can now not worry about counterparty risk and also have price transparency to the prices of those cargoes, of the cargoes and contracts on the market. And what does that do? That allows certainly the bigger firms that don't want transparency in the marketplace. They've enjoyed the opaqueness of the marketplace for many years now. But as the marketplace becomes what we call more crowded, meaning more participants in the marketplace, those participants may not have an MSA with a large trading firm, may not have counterparty contracts in place with a major trading firm. And so what can they do? They can come to the exchange, to Abaxx, and trade a Northwest Europe delivered contract, DES contract, into Northwest Europe as a medium-sized firm. As long as they have a relationship with a clearing firm of Abaxx, they can go onto the exchange and trade that contract and not worry about counterparty risk, and not worry about if I have an ISDA or an MSA in place with one of the big trading firms, and most importantly, get market price for those molecules that they want to trade and bring into a delivered a region like Germany or the Baltic or the Mediterranean. So that's really the key difference. And so what we see is more firms onboarding, and that's just takes a lot of time. Again, not being the first one to do that, we're the first one to do this in so many years. Firms have to look at the risk of coming on board with us, and we have clearing firms. We have 6 clearing firms now. We have many firms in the process of onboarding, and we're pretty, comfortable to say that we know that this is going to succeed because there's just such a huge demand for it.
And that really simplifies the process going forward as well for the entire ecosystem.
Exactly.
Now, one of the markets, Joe, to go back to your earlier comment about the Japanese market, which is really evolving fast, and the new strategic energy plan is supposed to be announced anytime. It's kind of due in the next couple of months. What are your thoughts on the draft that's been published, and your key takeaways from there?
I think the key takeaways is that the marketplace is still not looking at the physical marketplace as a hedge instrument or a price hedge instrument or a transparency instrument. You look at investment going back many years into the say whether it's Europe or the U.S. into pipelines and refineries and terminals, and those investments were done based on a transparent price in crude oil or in Henry Hub natural gas. And so when you have a forward price curve for those instruments, investors can then look and see and make investments based on that forward price. LNG, and particularly physical LNG, has not had that. And for lack of anything else, they've moved to financially settled instruments that are based on indexing and surveys around the marketplace versus actual trades of a large group of market participants. So how do you get confidence in the marketplace? You have a forward curve that an investment firm can go in and say, well, I want to make an investment in a new LNG terminal in Japan. What am I going to base my investment on from a pricing perspective? If there isn't anything, that doesn't give them the confidence to do that. With our futures contracts, that gives them a forward curve that they can say, well, you're out 2 years on your markets. Can you add another 2 years to help me place my investment with a certain price? And those are things that futures markets have done in the past with, as I mentioned, with things like WTI helping to price refineries and pipelines, or Henry Hub helping to price pipelines in the US, or Brent crude oil helping to price terminals in Europe. That what happens now is when the marketplace can look at our LNG forward curve, they can say, okay, I know what LNG is priced out 2 years. I can now make a better decision based on that pricing, and then make a better decision on the investment into that infrastructure that's so badly needed in Asia.
And I think some of these issues will be in the spotlight at the Japan Energy Summit and Exhibition, where Abaxx Exchange is a key part of the event this year as well. What are you looking forward to?
No, it's I think this is my 3rd year now going to it, probably 4th year maybe, or 2nd or 3rd year actually sponsoring it, and I spoke at it last year, and I'm looking forward to speaking again this year. And I think it's just a matter of education. Certainly the Japanese market is a conservative market, and they need to become comfortable with the counterparty, so to speak, that they deal with, whether it's an exchange or a trading counterparty. We're making great inroads with our relationship building in Japan, and we know that our futures contracts in LNG and carbon and even battery metals are resonating with the Japanese trading community, mainly because they're physically deliverable, have that optionality for physical delivery of carbon, lithium carbonate, LNG, that the marketplace doesn't have. And so if you want to build confidence in markets, you need to have an underlying physical market to trade that gives those trading participants, those market trading companies, a lot of comfort to be able to look at transparency and counterparty risk and manage their risk through the exchange.
Absolutely, and wish you all the best, Joe, for your speaking opportunity at Japan Energy Summit. And thank you so much for your insights and your thoughts today.
Thank you. We're looking forward to it very much.
Thank you. Thanks for joining, and I hope you really enjoyed this episode of the Energy Connects podcast. What were your key takeaways from this episode? We'll be delighted to hear your feedback. Post your comments in the conversation below. And a lot of the themes that you heard during today's episode will be in the spotlight at the Japan Energy Summit and Exhibition 2025, taking place from the 18th until the 20th of June in Tokyo. Make sure to get your delegate access at japanenergyevent.com. That's japanenergyevent.com. And don't forget to follow Energy Connects on social media to get comprehensive coverage of the energy industry. I'll be back with the next episode of the Energy Connects podcast. Until then, goodbye.